Hopefully we'll see a few people. There we go, we've got some participants. Good morning, everyone. We're just going to wait a few seconds more just to see if everybody's attending before we start the session today. We're just going to wait a few more minutes for some of the other participants to join, and we will kick off in probably about 15, 20 seconds. So I think that's most of the people are now with us. Good morning, everyone, and welcome to another of our webinars from Citywide Financial Partners. I'm delighted to see you all here today. We're going to be exploring something slightly different with Andrew Cain from Global Systematic Investors, or GSI as we know them, about whether big companies lead to big returns. And perhaps in terms of timing, timing is everything in life, of course. It's a really interesting time in the markets, particularly. Over the last few months, we've seen some very strong ramp up in stock prices, particularly from the likes of Amazon, Apple, Alphabet, which is Google, Facebook, and Microsoft. And as my son will tell you, he follows a Reddit page called Wall Street Bets. I don't know if anybody's had the opportunity to read that. It's quite amusing. They follow a thing called stonks. These are stocks that only ever go up. And of course, they don't always. And that's exactly what's happened this week. So it's been a really interesting time. He has his own strategy for investing, which I think is always quite amusing. Fortunately, he follows a slight barbell strategy. So some very risky investments on the one side and some slightly more conservative investments on the other. But I have to say, when I ask him how it's going and whether he caught all of the upwave recently, and he sort of looks at me and says, not quite, Dad, I missed out on Tesla. I do have a slight wry smile, but to say, fortunately, all he's doing is betting with his grant money, and we'll see how he goes. But anyway, we're not into doing that. We're into a really different approach, and I think it's an approach which we're going to explore in a few more minutes with Andrew. And I'm delighted to welcome Andrew Cain. Andrew is the managing partner at GSI, and GSI really are a factor investing firm. That's something that you should all be familiar with, because essentially what it means for you and I is that they take advantage of the returns from smaller companies and value stocks and the higher expected returns that they have. It's an approach which we've been following for nearly 20 years now, very, very successfully. And interestingly, GSI also have another element, or another sort of bow to their, arrow to their bow, and that is really that they also specialize in environmental, social and governance issues. And that's something that we're extremely interested in. Impact in society is always something that's really important to us, and I'm very delighted to say that GSI are taking some very strong steps in that direction. So from my point of view, Andrew, welcome to this webinar. We're delighted to have you speak. I know you're going to be talking about big companies and big returns, and that's with a very large question mark after it. Obviously, the experience has been, this week has been somewhat different than it was in the last few months with the drop-off of stock prices. But maybe you could just introduce yourself and just take us through a presentation, which I think all of you will find very, very interesting.
Clinton, thank you very much. And thank you everybody for taking the time out to join us today. I'll just get the presentation up and hopefully get it into, there we go. So as Clinton mentioned, yes, this is talking about big companies, big returns, question mark, and with a subtitle of why big is not always best in the investment world. And what I'd like to do is to address this issue of this incredible dominance that these huge US tech companies seem to have in the markets today, and say, is that something that we can expect to continue going forward? Are we destined to be dominated from an investment perspective by massive technology companies? Or is there something different going to be happening for our future? Now, obviously, the future is extremely difficult to predict. So what we do is we'll look backwards and we'll think to ourselves, okay, is there something we can learn from past experience? And so this presentation, in the presentation, what I'd like to go through is just a look backwards to see if we can get any insights into today and perhaps the future.
Andrew, you're not sharing your screen as far as I can see.
Oh, I'm sorry.
Make sure you do.
Let me see if I can share that screen. There you go. Hang on. Share. That's the one there. Brilliant. Hopefully you can now see the screen.
Perfect.
And I just open it up into
presentation mode.
Presentation mode. There we go. Are we all good?
Yep, we're good.
Brilliant. So looking back over the stock market history, we've got some graphs here that we put together. And there are two graphs. There's a longer top graph, which is the data from the United States, where we have lots and lots of information and lots of data going back to the early part of the 20th century. And what this graph shows, each of those blocks, those blue blocks, are 10-year periods. So we're looking at 10-year returns over the past, almost 100 years. And so the very first one, going back to 1936, that's looking at 10 years of returns from 1927 to 1936. And the return it shows there is just over 5% per annum for that 10-year period. And what you can observe looking at these graphs is that returns come and go. You can see this ebb and flow of returns over time. And the advantage of looking at it over a 10-year period is it smooths out a lot of the noise, a lot of that rapid rise, rapid fall, rapid rise, rapid fall, and gives you a sense of a sort of longer term pattern of returns. And what you see here is that there are significant periods when those returns are very positive. This is why investors are interested in investing in equities, because there are these long periods when you get very strong returns. And of course, from an investment perspective, that's what you're looking for. However, it's not the case that you get these strong returns all the time. And if you look in those periods when the returns went negative or near zero, you can understand why. So if you look at the very left-hand side of the US graph at the top, you can see that there's a period in the late 30s where returns went negative, and that was the Great Depression, and in the lead up to the beginning of the Second World War. Then, of course, after the post-war period, you had a boom time, effectively, when you had a large amount of growth in the equity market until you reach the 70s. And the 70s was a very tumultuous period, leading into the 70s, the late 60s and into the 70s. And a lot of it had to do with changes to how countries dealt with their currencies and their foreign exchange. And the US came out of the Bretton Woods Agreement and went off the gold standard. And yeah, there was a lot of turmoil going on there. And of course, you had the oil shock of the 70s as well, which hit economies hard. After the 70s, you go into the 80s and 90s, and you have another strong period of returns. In fact, as we all remember, through the late 90s, of course, there was a bit of a tech boom that happened then. We feel like we're revisiting that now. But then you get into the late 2000s and it all collapses again. And that, of course, was the global financial crisis that hit in 2007, 2008. And then subsequently, it's been a period of strong growth since then. The lower graph shows the equivalent for non-US markets, and it's over a shorter period of time, but you see a similar pattern. And you can take two things from this experience, these graphs. The first is, if you look at the bottom left-hand side, you can see that the return over the period, the per annum return over the long term for the US and the slightly shorter term for the non-US markets, the returns are on average 10%, roughly 10% per annum. And that's why investors invest in equity markets over the long term. And it's very important, the over the long term part, because the second thing you take from these is you can see that over certain periods, returns can be negative. And they can be negative or low for quite a long period of time. Remember, each of these bars is a 10-year period. Now, this information, this data, comes from the website of a very well-renowned and influential financial economist called Ken French. He and another very well-known, in fact, Nobel Prize-winning financial economist, Eugene Fama, have done an enormous amount of work on how markets function and how we can look at markets. And so what I'd like to do now is look at these markets through a couple of different lenses. And Clinton mentioned size, small companies, and also mentioned value. The first one I'd like to look at is the experience of small companies versus large companies over the long term. Now, these graphs are constructed in much the same way as the previous graph, but there's one important difference. The graphs are the net difference between the returns of small companies, in this case, versus large companies. So each year, it's a portfolio of small companies, the returns of the portfolio of small companies minus the returns of a portfolio of large companies. So this is the net premium that you get for investing in small companies rather than large companies. So how much they outperform large companies over time. Once again, these are 10-year periods, 10-year blocks. And you can see that it's very much more up and down than the previous graph. And there are these extensive periods when small companies underperform large companies through the 50s, through the 90s, and then just more recently in the most recent period. Non-US developed markets, a much shorter period, but you get the same picture. So small companies have these long periods of outperformance and long periods of underperformance. So there's a lot of risk there. But if you're prepared to stay invested in them over the long term, if you have a strategic exposure to smaller companies, it's very attractive to investors because the premium of small companies over large companies over the long term, if you look on the bottom left-hand side again, in the US over the long term, that has been north of 2% per annum. In the non-US, which is much more recent and not quite as extensive a length of time, it's still it's just not far off a percentage point. It's 0.89%. So it's a very attractive proposition for investors to have some exposure to smaller companies. And of course, this is important because today it's not the smaller companies that have been driving returns, it's these mega cap tech stocks. So the next element, the next lens I'd like to look through is this concept of value. Value is defined as essentially a company's price relative to some fundamental value, some fundamental accounting fundamental. It could be earnings to price, it could be cash flows to price. It's some relationship between price and an accounting fundamental. And a value company is defined as having a low price relative to those fundamentals. Some people call it cheap, but let's just stick with low price for the time being. So a low price relative to its fundamentals, whereas a growth company, a growth stock, has a high price relative to its fundamentals. And these, if you categorize companies by their value and growth characteristics, you can create portfolios of companies that have very different returns. And Professors Farmer and French noted that over the long term, value companies significantly outperform their growth counterparts. And these two graphs show that. Once again, this is the difference, the net difference between the returns of value companies versus growth companies. So this is the premium return you get for investing in value versus growth. And it's in 10-year blocks. And you can see in the first few years in the States, there was this underperformance through the 30s. This equates to the Depression. Then there was growth in the stock market. It's a little bit the naming convention can be a bit confusing, but there was a strong economic growth, and value stocks did extremely well over the post-war period, and all the way through into the 90s until you reach the late 90s, when you see there's the next negative return. The bars go red, and of course that was the tech boom of the late 90s. In the early 2000s, that turned around very quickly, and you had a period of strong value performance. And then in the late 2010s and since then, we've seen a very strong resurgence of growth stocks driven by these high-tech mega cap companies. And a lot of that has been the consequence of quantitative easing, this what people sometimes consider to be very, very easy, free and easy money, very low interest rates. And that has spurred growth and growth companies, particularly. You see a similar experience in non-US developed markets as well. And you can see why value for the patient and long-term investor is appealing. You look at the premium in both the US and the non-US stocks, and the premium for value exposure for value companies is north of 3% per annum. And in the non-US, over the shorter period, has been north of 4% per annum. So extremely attractive investments for investors to get exposure to. But not recently. Recently, we've seen these massive companies taking sort of center stage and headlining. And so is this something, has there been some sort of change? Are we living in a new world? Well, to answer that, what I'd like to do is I'd like to look back 40 years and say, well, let's have a look at the past 40 years. And is there something we can learn from those last 40 years? So what I've done here is at the beginning of each decade, starting in 1980, I've listed the top 10 stocks that existed, that dominated the markets at the beginning of each of those decades. So we go 1980, 90, 2000, 2010, and then today, 2020. And we go back to 1980, and the top 10 stocks were, their names everybody should recognize, or mostly they should be very recognizable to people. Top of the table was IBM, very, very big mainframe computer producer, but at the time was bringing out the IBM PC. Next down was AT&T, obviously the massive US telecoms company, and then Exxon, Standard, Schlumberger, Shell, Mobil, Standard Oil. And so the top 10, with the exception of IBM, AT&T, and GE at the bottom, the top 10, 7 of the top 10 were big oil or related to energy. 9 of the top 10 were US companies. Only Shell was not a US company. And it's not surprising that in 1980, the top 10 was dominated by big oil. We'd just come out of the 70s with massive increases in oil prices that had been a huge boon to these oil exploration and production companies. And they'd seen their stock prices go up and up and up. So 1980, dominated by the US and dominated by energy and oil related stocks. Fast forward 10 years to the 90s, to the beginning of the 90s, 1990, and the deck of cards has been shuffled. In 1990, the top 10 are no longer dominated by the US. 4 of the companies make it through from 1980 to 1990. 6 of them are newcomers, and all 6 of those newcomers are Japanese. So 1990 reflected a period, or the names at the top 10 of 1990 reflected a period of massive growth in Japan and massive growth in the Japanese stock market. And at the time, Japan was out there buying everything. They were making huge investments in property in the States, in the UK, all over the place. And Japan Inc. dominated the world. And at the time, everybody felt, well, you know, maybe Japan will become the largest economy in the world and overtake the US. Well, fast forward 10 years, and that wasn't the case, clearly. So we go to 2000, and 2000 sees a shuffling again. The only Japanese company to make it through from 1990 to 2000 was NTT, and it takes up 2 spots in the top 10. NTT Docomo was the spin-off mobile group from NTT, the overall telecoms group. So they spun that off, and it became a very large and powerful company for a while in Japan. And then the remainder had 4th spot on the list. We see Microsoft appear for the first time in 2000. It's been around for a little while, but it made the top 10. In fact, got to the top spot in 2000. And we see, you know, 1 or 2 others coming in. But 2000, there was a bit of a mix. There was some old stock type stuff with Exxon still there, just about. Deutsche now appears, so you get a few non-US companies. It's a bit more international as a mix, but very different to the earlier 2 decades. As is 2010. So we move forward, and in 2010, the only company to make it to 2010 was Exxon. The only reason Exxon made it to the top 10 was because they merged with Mobil and created this behemoth of an oil and energy firm. So they stole top slot from Microsoft. And you see, there's now a few other companies come in. HSBC makes it there. Shell makes it back again from a bit of an absence. Nestle's there too, so a bit of a mixture. 2010 to 2020 is a major change, a major difference. All of a sudden, we've now gone from being a bit of a mixed bag of countries and sectors or industries to being dominated by the names that we now know and are very familiar with. As Clinton mentioned at the very beginning, there's these massive tech stocks: Apple, Alphabet, Google, Microsoft, Amazon, Facebook, and so forth. So the top 5 slots are taken by these huge tech companies. And then the rest, the bottom 5, are all US companies. So we're almost back to 1980s again, with the US dominating, in this case, dominating the full top 10 slot. So a very different a group of companies. And what this has shown us, what this tells us, is that there's an enormous amount of turnover and change, driven partly by demand, partly by changes in technology and competition. And so what's going to happen next? Well, once again, I can't tell you what might happen next, but I can give you another way of looking at this, which I think is quite an eye-opening experience. So what I'm going to do now is I'm going to go through what happens if you start in 1980 and you build 2 portfolios. You construct 2 different portfolios. The first portfolio is going to be a portfolio comprising the top 10 stocks in each year. So you start in 1980, and January 1, 1980, and you say, what are the largest 10 companies in the world? And I'm going to create a portfolio of those largest 10 companies. And I'm going to hold that portfolio for a year. And then at the beginning of the next year, in this case, 1981, I'm going to say, what are the 10 largest companies in the world? And I'm going to rebalance my portfolio, my 10 stock portfolio, and to the top 10 for that year, and hold it for another year, and so on and so forth for the full 40-year period. And I'm going to find out what my returns were over that period. I'm going to do the same for a much larger or much more diversified portfolio. I'm going to say, what if I do the same thing for the largest 2,000 stocks in the world? Once again, starting in 1980, beginning of 1980, what are the largest 2,000 stocks? I'm going to hold a market-weighted, by the way, these are all market-weighted portfolios, a market-weighted portfolio of the top 2,000. I'm going to hold it for a year, rebalance January 1 the following year, hold for a year, so on and so forth, right the way through to today. And look at the returns that I achieved from my portfolio of 2,000 stocks versus my portfolio of 10 stocks. These are the results. And these are the per annum returns for those two portfolios. Now, if you'd been invested in the top 10, you would have had a pretty good experience. You would have had something that wasn't too far off the long-term average return of the stock market. You would have achieved a 9% per annum return in your portfolio, which is nothing to be sneezed at. You would have been slightly disappointed, though, if you then looked at your top 2,000 portfolio and realized that you'd missed out on nearly 3% per annum of return. So your top 2,000 portfolio over the same period, just running the same simple methodology, would have returned 11.9% per annum, which is a full 2.9%, almost 3% difference per annum. Now, another way to look at that is to say, well, how does that mean from an investment perspective? What would happen to my pound if I invested it in the top 10 versus if I invested it in the top 2,000? Well, the lower blue line is your pound if invested in the top 10. If you'd invested a pound in the top 10 and held it over the period, reinvesting each year, you would have ended up just slightly north of 30 pounds, about 31 pounds as an investment by the end of your 40-year period. On the other hand, if you'd invested that pound in the top 2,000, you would have ended up with about 90, just over 90 pounds worth in your investment portfolio. So this gives you a very, very strong understanding of what the difference in returns between investing in the darlings and the very large companies of their day would have been like versus just a regular broader investment. And it supports that research that we went through at the very beginning about small company returns and value company returns, because the top 10 companies are dominated obviously by the very largest. They are the very largest in the world, but those very largest companies tend to be very, very strong growth companies. They're not entirely, but they tend to be dominated by growth companies. So your top 10 investment here, which isn't a realistic portfolio, by the way, is dominated by the mega cap companies and dominated by growth. Whereas your top 2,000 is a much more, should we say, diversified portfolio. And not necessarily the one which would give you the highest returns. You could increase returns by having exposure to greater exposure to smaller companies and value companies, which of course is what Clinton's group specializes with. So that I think in conclusion, I think we can say that whilst I'm not prepared to make a prediction about what will happen next, I can certainly look back and say, well, if the past is any kind of guide to the future, which it isn't always, I don't think we'll be seeing the very largest tech companies of today dominating stock markets going on into the ever distant future. Thank you very much.
Thank you, Andrew. And I think that's an absolutely excellent presentation. I think it manages to get over the point that particularly at the moment, when large tech stocks are doing so incredibly well, many people probably have got a fear of missing out. Actually, that isn't a realistic thing that they should have, because as we know, when you look back over time, you can see that the returns really do accrue to a much broader portfolio. Interestingly, I mean, you've used the top 2,000 stocks, as you know. We invest in nearly 11,000 stocks with those tilts to smaller companies and value stocks. And that was because we believe that the academic evidence suggests that it's going to be better for clients over the long term. But I think what's really interesting about this is the sort of fear of missing out. I think as humans, we would quite naturally feel that are we getting the best out of our portfolios? That when we see the likes of Tesla shooting through the roof, and we see my son with his stonks telling me that this is the way to invest. That the working assumption, of course, is that these are the best places to be investing. But as I kind of remind myself from time to time, Tesla is essentially, as an example, is really just at the beginning of the electrification of cars. And in the same way as when Ford was producing their cars right at the beginning, one would reasonably have found other manufacturers doing similar things. I know it takes years and years and years to see who the winners are. And I think that what we've been able to demonstrate with this presentation is really that for individuals, it's almost impossible to see which is going to be the best performing stock over even a relatively short-term period of 10 years, let alone over a period of 30 or 40 years, which many of our clients will be investing over. So I think that's thank you again for the presentation. I think it's been really, really excellent. For our viewers, audience, thank you for listening. I hope you found that really interesting and informative. We would be very interested to know to get some feedback from you. Really feedback both on the presentation itself, but also I think really feedback on what you'd like to see next. I think we've over the period talked about a few different issues, and I think there is other areas that we can talk sensibly about. One of the things that interests me is obviously educating children, are really about the finance. I think that that's something that is always important. I'm always slightly surprised and a little bit amazed to some extent how little even young adults have in terms of understanding of the financial markets. But I think there are other areas that we would like to hear from you about, so that we can really get a feel for what we might like to do next. Obviously, there's lots of technical information we can bring, and we're very happy to do that. But I think it would also be really interesting to talk about other areas that may be more interesting for you. So on that note, that brings to a close this presentation. Thank you for spending the time with us. I hope you enjoyed it. If you have any questions, please feel welcome to send us an email or follow up in the response afterwards. Thank you for me, and thank you for Andrew, and we look forward to seeing you again shortly. Goodbye.